Good morning, everybody. Welcome to today's pension webinar. I'm Melanie Warnes. I'm the Deputy National Secretary for the Police Federation, and we're joined today by Paul Turpin, who'll be coming on in a second to give you loads of information around pensions. So today's webinar, unfortunately, we can't take questions. We know literally hundreds have come into the mailbox over the last week or just under a week, but because of the amount of people, we can't take specific questions. But this webinar is absolutely full of information that I'm sure will answer many of the questions that you do have. If it doesn't, then our Police Federation website pensions page has a huge amount of information on there. Please visit the website. It's up to date and will continue to be updated at every point. We're working on it all the time with the information. So there's loads of information on there on the pensions page, as I say, on the website. Paul's slides today will be circulated to all of you that are registered. So you will receive those slides, probably not today, I'd say tomorrow. And the slides will also be uploaded onto the website, so anybody is able to go onto there to have a look. Today's webinar is sponsored by Met Friendly, now Police Friendly, who is, as you saw just on the couple of slides before we started, they do pension webinars, etc. So do have a look at their website as well. At the end, there'll be an evaluation feedback QR code. Please do just spend a couple of seconds giving us a little bit of feedback using that QR code. It does literally take just a few seconds, and we do welcome any feedback that you have around these webinars. So just before I hand over to Paul, again, this is full of information for you. So we can't take specific questions. Any areas, if there's some clarity on anything, I do have access to the chat bar. If you've got points of clarity, then do pop those in, and I can get round to those with Paul if necessary. So thanks again, everybody, for joining, and I'll hand over to you, Paul, to do a quick intro and share your slides. Thank you.
I'm Paul Turpin, and I work for both the National Federation and for the Met Federation, dealing with all things pensions. And once we get the slides up, we can start to go through. We're going to deal with lots of different things from the pension this morning. There's an awful lot of information on here, but as Mel says, you'll have access to it. You'll have the slides, so you can look at it in slower time, and also you'll have if you want to listen to if you really do want to listen to this again, then you'll be able to listen to it again. And obviously it's got lots of links in it as well, which some of it to outside stuff, but there's some useful links in there, and we'll obviously keep the links in so you can use those as well. So we're going to go through, this is a list of what we're going to go through, the exit points of when you can leave the pension and leave the job with an immediate benefit from your pensions. We'll go through an overview of the different schemes, the three different schemes, talk about index linking, survivor benefits, which is not a great subject, but something we all need to think about. A bit about remedy, not too much about remedy. We could do a whole morning on remedy, but we'll do a little bit about remedy. Annual benefit statements and remedial service statements about the latest rollout, and also the rollout which is still happening. Talk a little bit about interest, contingent decisions, which are not so prevalent now, but we'll talk about contingent decisions. A little bit about the annual allowance. Compensation that you can get from the force for independent financial advice. We get a lot of queries about added pension, so we'll talk about added pension. And then what we'll try to do, we'll try to go through the NPCC calculator and give you some ideas of how you can get the forecast. Getting forecasts from your administrators is not easy, and we know that. So we'll talk about some forecast issues, and we'll talk about the NPCC calculator, which you can use yourself to get your own forecasts. Thanks, Claire. So one of the myths we need to dispel straight away is that there's no such thing as a full pension any longer. in the final salary schemes of the 1987 and 2006 schemes, there was maximum accrual. So you could only, within 1987, you could only get 40/60. So once you got to 30 years, unless you wanted to get your pension increased with pay rises, there was little point in staying in the pension because you'd reached maximum accrual. Same with the 2006, not that many people got to 35 years, only people who brought in lots of service with them got to 35 years. Now there's no such thing as a full pension because there is no maximum accrual. You can carry on accruing pension for as long as you want to. And I know that fills some people with horror, but you can go on working beyond 60 if you want to. There's no extensions in the police pension any longer. There's no compulsory retirement age. On the 1st of April 2022, compulsory retirement age and extensions became a thing of the past. So you can carry on working beyond 60. And if you do carry on working beyond 60, they actually increase your pension as well as the accrual in your pension, and the inflationary increases, you get a further 4% a year. So what we're finding, and which is it's all new to us as well, what we're finding is some people have come to us in recent times with their statements, and it's better for, even with the 1987, for the older members, it's better to go to the 2015 scheme. None of this is today is financial advice, just information in it, and you need to do your own due diligence for your own figures. But what we're finding is, the 1987 scheme in some respects is not the best pension for people who are older in over 60 because of the actual uplift in the 2015 scheme. So there is no such thing as a full pension, and we need to get away from it. I get that asked all the time. When can I leave with a full pension? So what you need to work out now is the access points, the exit points for your own circumstances, so that when you can leave the pension and when you can take a benefit. So the earliest anyone can go is in terms of in the 1987 scheme is 25 years. So if you've got 25 years across the schemes, you can take the 1987 scheme, and if you're over 50, you can take that immediately. We're getting lots of people now asking to go, or asking for forecasts, who are in their 40s, who've got 25 years service, who are saying, well, I'm going to leave and I'll take my 1987 pension at 50. So that's happening more and more, but that's the earliest anybody can leave, is in the 1987 scheme with 25 years service. If you're over 50 or over, you can leave immediately. If you're below 50, your 1987 scheme is deferred until you're 50, and we're getting a lot of inquiries about that now. If you are 50 and you want to take an immediate benefit from the 1987 scheme, the commutation's capped at 2.25 times the gross pension, with a higher residual pension. So the pension that you receive each month and each year is higher because you're taking less commutation, but the commutation's capped at 2.25 times the gross pension. This is why it's very important for people to get to the 30-year miles. If you want the full commutation factors, you need to get to one of the milestones where you can get the full commutation factors, either 30 years or 55. We've had an example a little while back where an officer who thought he had 30 years and went away on holiday, went to the cash point on the day after he retired to see how much commutation had come in, and he was shocked to find it was about £100,000 difference, because he'd only had 29 years and 361 days service, not 30 years. Luckily, it wasn't his fault, and the force sorted it out for him. But that just shows the effect. It is a huge difference in commutation, but the residual pension is higher. As a result, in Scotland, I don't know if we've got any. I don't think we've got anybody from Scotland here, but in Scotland, there is no commutation cap. So at that stage, you can take the full commutation factors. And as I said, if you're less than 50 with 25 years service, the 1987 pension is deferred to 50. The 2015 scheme at that stage, if you take the 2015 scheme, the first time you take the 2015 scheme is 55. So if you take the 2015 scheme before 50, sorry, if you take the pension and leave the pension before 55, the 2015 scheme is deferred to your state pension age. And that's what it'll say on a lot of the forms you'll get from XPS, Equinity, and the administrators. It will say, if you leave before 55, the 2015 scheme is deferred until your state pension age. That is technically true, and that is what the official position is. But you can take a benefit from it at 55, even if you leave before 55. But it is actually reduced by 50% or close to 50%, depending on what your state pension age is. So it is available to take at 55, even if you left before 55. But there is a large actual reduction for doing so. Done that. 2006 pension. So even in 2006, they knew what the the pension age was an issue, because the first time you can take the 2006 pension is 55. So they knew in 2006 that they needed to increase the pension ages, but they didn't do it. What they did, they said to the 1987 members, if you want to go across to the 2006 pension, you can, but you don't have to. Some people did, not many people did. So the 2006 pension, the first time you can take an immediate benefit from the 2006 scheme is at 55. If you leave before 55, it's deferred to 65. That's the trouble with the pensions. It's all over the place with the different, the 2015 to state pension age. If you defer the 2006 is 65. If you leave the 1987 pension before 25 years service and before 55, it's deferred to 60. So they've all got different deferment ages. Again, the 2006 pension, if you do leave before 55, and you can come back at 55 and take a benefit from it, but it is 50% actually reduced. There is no ability to take the 1987 deferred pension before 60 unless you're ill, unless you've got you bring it into early payment due to ill health. So all different deferment ages and different provisions within the deferment. So 30 years across the schemes. When you get to 30 years across the schemes, you're a 1987 legacy member. You can take your 1987 pension at any age. So I've had people this week who are 48 and 49 who are going to go with 30 years service, and they can take that 1987 pension at that point with the full computation factors available to them. The full commutation factors are also available for any service, any ranking that this becomes quite complicated and is only if it affects county inspectors and above, or sergeants in the counties who want to be promoted to inspector. So they've got different compulsory retirement dates. So if you're 55 in the Met at any rank, or sergeant and PC in the counties, you can take the full commutation factors with any service at 55. If you're a county inspector or above, that age is 60. If you've got 30 years, it doesn't matter. That doesn't come into effect. It's only if you want to take the full commutations of facts at 55, and with any service. For any rank in the Met, PTs and sergeants in the counties can do that. County inspectors can only do that at 60. And also we get some people. It comes up more than you'd think. And we've had some forces where they've reduced people in rank because sergeants, they've reduced them back to sergeants, which is the same effect because they still get an inspector's pension because of the way that the pension's worked out. But I wouldn't worry about that too much. But if it does affect you, then speak to your local federation or come to us and we'll explain that to you. Again, it's quite a complex. I don't know why, we don't know why that is, but it's gone back. We traced it back to something like 1947. And they've not changed the compulsory retirement dates in terms of the pension since that date. But if you've got 30 years across the schemes, you can go take the 1987 at any age with the full commutation factors available to you. As we said earlier, 55 is the first time for immediate benefit from the 2006 and 2015 schemes. If you do take if you do work to 55 and take the 2015 scheme, it's actually reduced by 22.5%. There's no actual reduction in the 2006 scheme for active members, and a lot of people will go at 55 and take that actual reduction from the 2015 scheme. I cover it again later. We do get inquiries, a lot of inquiries from people say, well, I don't want to take my 2015 pension at 55. I'll leave it at 55 and defer it. That's not a great idea, because if you do defer it at that point, it's deferred to your state pension age, and then the actual reductions are from your state pension age, not from 60. It's an anomaly, and when we've taken it up with the Home Office said, well, why wouldn't somebody want to take their pension when they can, which is a fair point. But trying to defer your 2015 scheme from active service is not again, not financial advice, but I would take some serious financial advice before doing so. So in the 2015 scheme, once you reach 60, there's no actual reduction as an active member. So if you retire at 60, no actual reduction on the 2015 scheme. And if you work beyond 60, then there's a 4% actual uplift. And as I said, there's no compulsory retirement age anymore. So there's a lot of information in this one slide, but that gives you the points you can leave the pension, your access points, your exit points. So it's important to know your exit points. And the good thing about the NPCC calculator, which we'll go through later, is that it does give you all the exit points for you with your circumstances. Thanks, Claire. So we'll have a look at the schemes in a bit more detail. The 1987 scheme closed an active scheme on the 31st of March 2022. So all active members are now in the members of the 2015 scheme. Although it's closed, it hasn't stopped growing. So the 1987 scheme still grows with pay rises and promotion as the final salary links been maintained, and weighted accrual. So in the old scheme, before the 1st of April 15, the first 20 years of your service in the 1987 scheme, you would accrue 1/60th each year. So at 20 years, you'd accrue 20/60ths. The years from 20 years to 30 years, you would accrue 2/60ths. So by the time you got to 30 years, you had your 40/60th, your 2/3 of your final salary as your pension. That was lost when the new pension came in. That was lost. The double accrual was lost. So weighted accrual was brought in by the government to compensate for the loss of double accrual. If you want to read about the weighted accrual, there are some useful examples in the 2015 members guide. And there's links to be links later on where you can find the 2015 members guide, or it's easy searchable on Google. There are 3 or 4 pages on the 2015 members guide about weighted accrual with examples. So if you've got 30 years across the scheme now, you don't divide your, so to calculate your 1987 pension for 30 years, you would look at your reckonable service at 31st of March 2022, divide that by 45 and times it by your final salary, and that would give you your gross pension for the 1987 scheme. The weighted accrual does make a difference, and the weighted accrual factors get higher if you don't get to, so 45 is the most, but they get higher because obviously you get less pension. So if you get 29 years, there's a different factor which gives you less pension. So the pension does increase, still carries on increasing. It rises. You've had a 4.2% pay rise in September, so it will rise again reasonably again this year. So it rises with the pay rises, the weighted accrual and promotion. And also temporary salary if you've got temporary salary. The final salary is a backward looking. So I get questioned all the time about, oh, the pay rise was 4.2%. I can retire on the 31st of August. Shall I go into September and get the pay rise? It doesn't make that much difference because it's a backward looking calculation. If you went today, what's today, the 4th of September, you would get 365ths of the pay rise as in your final salary. Because as a backward looking, it would be 361 days at the old pay rate and 4 at the new pay rate, and that's how they work out your average pensionable pay. The pension never drops. We get that question a lot. The pension never drops. The commutation factors drop each month, and I think we'll look at the commutation factors in a minute. And they drop every month from 48 to 6 months. But just because the commutation factors drop in, your commutation is not necessarily dropping. If you're still in active service and below 30 years, then the weighted accrual and the pay rise will see that your commutation will still increase. Even after 30 years, it won't drop the commutation if the pay rise is above 1.5%. There may be other reasons to leave it after 30 years, but the commutation dropping is not one of them. If we had pay freezes, then that things would be different. But at the moment, with the pay rises as they've been, and with weighted accrual, the commutation is increasing, and also we've had increases in commutation factors. Overtime is not pensionable. The only things that are pensionable pay is basic pay, temporary salary, and London waiting, and additional part-time hours that part-time officers work up to their 40 hours, that they're pensionable as well. The commutation, you can take 25% of the pension tax-free, but if you're so it's tax-free, but there is a tax charge, which is, I know, but it's gobbledygook, but it's unfortunately it's the pension world. If you're younger than 62 years and 2 months and you take the maximum lump sum, there will be a tax implication on the commutation. It's not personal taxation, it's taxation on the scheme. It's an unauthorized tax charge on the scheme, because at 62 years and 2 months, the commutation factor is 20. HMRC's rule is that any commutation factor that's above 20 attracts a tax charge, which is a tax charge on the scheme, which is passed on to the member lawfully. You can take a smaller amount to avoid the tax, but a lot of people do take the maximum lump sum and take the tax hit. The closer you get to 62 years and 2 months, the smaller the tax. Roughly, if you're at 50, it's about 8% of the commutation. At 55, 5% of the commutation, and at 60, 2% of the commutation. We got no idea when the next commutation factor change will be. The last one was the 3rd of April 2023. There's no guarantee that it'll go up either. We were in a meeting with the Home Office, the Superintendents Association and the Federation were in a meeting with the Home Office on 11 o'clock on the 3rd of April, and they let it out of the bag that the commutation factors were going up. We said, well, when are they going to go up? They said, you can't tell anybody. They went up. They actually published it at 3 o'clock that afternoon, because once it was out of the bag, they had to publish it. So the people who left on the 2nd of April had the old commutation factors. The commutation factors come into effect on the day they come into effect. They don't go backwards. You may have seen the budget rumours have all started again, and there's rumours going on about the commutation tax and the commutation again. We don't know what's going to happen in the budget. We wrote a letter. I know people take the mick out of the Federation for writing strongly worded letters, but with the other staff associations, we wrote a letter to Rachel Reeves last year about the don't put the tax on the commutation or change the commutation position, and apparently from the feedback she did take notice of what the representation she had made, and we are intending to write another letter this year, because again the rumours are out there, and I think they just float the rumours to see what pushback they get. The only other thing about taxation, there are two issues with commutation and tax. You've got the unauthorised tax charge if you're below 62 years and 2 months and take the maximum. There's also the lifetime allowance. It's still got a maximum of £263,275 that you can take tax-free from any commutation. So for the higher ranks, that you could still breach the lifetime allowance maximum lump sum, but that's something that they would have to take some advice on. Again, you can avoid it by just taking the maximum available. So there are two, but they are two separate things, two separate entities. Thanks, Claire. And if by magic, here are the commutation factors. As you can see, they drop from 48 years and 6 months. The ones in orange are only used for basically only used for IHR, really, for ill health retirement. So from 48 years and 6 months, they drop each month. The big ones, as you can see, 50 is 26. So what this is this is what you get for every £1 that you give up for your pension for commutation. So at 50, you get £26.90 for every £1 you commute. 55 is a biggie because that's a big age now in the pension world, and that's £24.30. Bear that in mind when we talk about the 2015, because the 2015 pension, it's £12 for every £1 you commute, flat rate across whatever age. Oh God, you're not reading this. They want to restart my laptop. You're not going to believe that. I'm not sure what we're going to do about that. So yeah, so that's £24.30 at 55, 60, £21.40, and at 62 years and 2 months, you can see that the factor is 20, and that's where that's what the reason there's an unauthorised tax charge before that is, because all of those factors are above 20. I'm not sure what I'm going to do about that, Mel. They want me to restart my computer in 14 minutes.
Isn't there a way to defer it?
No, it was just confirm or restart. So okay. I'll carry on for a minute, but I might be leaving you shortly.
All right.
I'll come straight back.
And then you'll come straight back. Okay, thanks, Paul.
It's the technology. Sorry, Claire, that can move on now. Thank you. So then moving on to the 2006 scheme, that came into being on the 1st of April 2006, and as I say, 1987 members were offered the chance to go across to the 2006 scheme. Not many did, and again it closes an active scheme on the 31st of March 2022. It still grows with pay rises and promotion. The final salary, there's a final salary rank, but the final salary rank there's no weighted accrual, so there's no weighted accrual in the 2006 scheme. The 2006 scheme, the final salary is calculated differently, and so if you are a 2006 member, make sure that they do calculate. There's 3 ways of calculating the final salary, 2 of which have got an inflationary aspect. And what we found recently, we didn't know about this until recently, an officer came to us and her average pension pay was higher than it should have been, or looked higher than it should have been. So when we checked with the force, they said, they point us in the direction of the regulations. And because inflation's been high in the recent years, like in the 2022 to 2023, it was 10%. Because of the way that the final salary is calculated, it gave a better average pensionable pay than the final year. So if you are a 2006 member, make sure that your pension administrator calculates your pay, your final salary, in the right way. If inflation goes back down to normal levels, which it's starting to by the looks of it, then that won't be an issue. But if at periods of high inflation, it may not be the last year that was the best year. It was a 35-year pension. As I say, not many people got to 35 years. We had a couple in the Met that did, because they brought in a huge amount of military service, but by and large, nobody's going to get to 35 years. And you used to accrue, rather than 1/60th, you accrued 1/70th for each year, and there was no double accrual. So once you got to your 35 years, you'd have half a final salary pension rather than a 2/3 final salary pension. There's automatic commutation in the scheme, so it's 4 times the gross pension. There is no degradation. They don't take anything off your pension for taking your commutation, whereas they do so in the 1987. There's no tax implication on the commutation, and as I say, no reduction in the pension for taking the commutation. You don't have to take all of the commutation. You can swap it. You can swap all of it for more pension, or you can swap some of it for more pension. There is a lot of flexibility in the pension on what you can take and the options you can take. You won't get, when you get your statement of benefits when you retire, and when you get your remedial service statements, they won't show you all of the options available to you. But we'll go through some more of the options a bit later. But there is quite a lot of flexibility on what you can take. As we said earlier, you cannot take a benefit from the 2006 scheme until you're 55. So that's the first time you can take an immediate benefit at 55 from active service. And I say, if it's deferred, you can still go at 50. You can still take it at 55 if you deferred it, but there is a 50% actual reduction. We're not finding there's not a great deal of difference in the benefits with the 2015 scheme. The actual reduction of 55 in the 2015 scheme seems to be the difference. So if people are retiring at 55, we're finding that the 2006 scheme is better. People retiring at 60, we're finding that the 2015 scheme is better. But as I said earlier, everybody is different, so make sure you check your own figures and get your own figures checked, and that you make the right decision for your own circumstances and for your own pension figures. And as I said earlier, we even find for older members now, we're finding that the 2015 scheme is better than option than the 1987 scheme. But everyone's circumstances are different. Unless you joined exactly the same day with exactly the same date of birth and you stayed exactly the same rank, everyone's going to be different. Thanks, Claire.
Paul, before we move on, do you think it would be best to have maybe a 5-minute break now, and you just do your computer, and then we'll come back to the next slide?
That sounds like a good idea.
Okay, so 5 minutes, everybody. We'll just pop some bits back onto the screen for you to look at QR code wise. But Paul, if you want to,
yeah, I'll do that now.
Update now, and then we'll see you in about 5 or so when you're back online. Okay.
Lovely, thank you.
Beautiful.
So we just finished off on the 2006 scheme, and now we move on to the 2015 scheme. So it came into being on the 1st of April 15, which is amazing now, because we still talk about it as a new scheme, but it's been with us now for over 10 years, and all active members are now in this scheme. So if you're an active member of the police pension scheme, you're in the 2015 scheme. We are going to do some more work on we got a webinar on the 2015 scheme in November, and we're going to do some more work around the 2015 scheme, because we think around about half the police officers in the country now are in the 2015 scheme solely. It's a career average scheme, and you officers accrue 155.3 of their average pensionable pay into this 2050 scheme each year. So for a top rate PC using the current pay scales, that's a typo, which you don't notice until you start reading. For a top rate PC using the current pay scale, that would equate to £930 being added to their 2015 pension amount this year. So what they do, they add that £930 to your pot that you've already accrued, and then in the next April they uplift it with inflation plus 1.25%, and they do that every April. So you can see with the high inflation of recent years, the 2015 scheme went up considerably. We don't know what the increase will be next year because they use the CPI from September, which is not published until the middle of October. It'll be around about, I reckon, another 5% next year, because I think inflation will be around about 4% in September. So we're looking at a 5% increase, but on the whole pot. And then then the following year, you add your 155.3 of your average pensionable pay into the pot, and then it's uprated again the next April by CPI plus 1.25%. In April 2024, the increase was 7.95%. In April 2023, it was 11.35%. Last year was 2.95%. I say next year, I reckon it'll be around 5%. But if I knew what the inflation figure was, wouldn't be here talking to you today. I'd be Chancellor of the Exchequer. So, but you know, inflation does have a big effect on the 2015 scheme. Officers can commute a maximum of 35.7%, so it's higher than the 25% of they can commute for commutation, at a rate of £12 for every pound commuted. So the commutation rates are a lot less than the commutation in the 1987 scheme. There's no tax implication on any amount taken in commutation under the 2015 scheme. And you don't have to take commutation from the 2015 scheme. You can take commutation from the 87 or the 2006 and not the 15. You can do the other way around. I say there's lots of flexibility, but you don't have to. I say not financial advice, but just something to consider. I get used this analogy all the time. If you're selling your car for 24,300, somebody offered you 12,000 for it, you tell them to do one. Well, that's effectively what the government are doing with the difference in the commutation between the two, for the 1987 and the 2015. But as I pointed out, there will be some people that are in the 2015, solely in the 2015 scheme, or have got more service in the 2015 scheme. So then people will have to make their decisions based on what they want from the scheme. Actual reductions can be brought out, and there is. In the links you'll be able to find, so the 22% from 55 or the 50% from state pension age can be bought out. It's not cheap, but we've had several people look at it recently, so you can do it, but you can't. But as I say, the table that they use is in the slides. You'll be able to find through the slides. One positive from the change in the scheme, which is not a great positive because it's death in service grant. Death in service grant is now 3 times average pensionable pay, where it used to be 2 in the 1987. And as I mentioned earlier, deferring from active service at 50. So if you want to retire at 55 from active service and you don't want to take your 2015 scheme, it's deferred to your state pension age, not to 60, not to when you want to take it. It's deferred to your state pension age. And so I say not financial advice, but take some really strong financial advice before you defer it to 67 rather than take it immediately. And also the pension ages are going up. You know, mine now is 67, and I'm on 65 date of birth, and I think soon after me it goes up to 68. Another thing to consider with the 2015 scheme, which I've now forgotten to defer death in service now to defer to 60-55. Oh yeah, the pension freedoms. I get the question quite a lot. The pension freedom age for private sector pensions is going up to 57 in 2027. It doesn't affect police pensions. Police pension age will still be 55, so it doesn't affect us. Well, it doesn't affect the police. There'll be more on the 2015 scheme as we go through the presentation, but that's the main bones of the 2015 pension. Claire, please. So I said there is lots of the flexibility. The choices that you'll be given are not all the choices you can make. So if when you leave you're just a 1987 member, you can't take the 2015 the pension yet because you're not yet 55. There are 4 options with the commutation. So you can take none and just take the gross pension. You can take the maximum tax-free with the commensurate residual pension, or you can take the maximum lump sum and pay the unauthorised tax charge if you're less than 62 years and 2 months, and then take a small. So if you take the maximum tax-free lump sum, the residual pension will be higher than you take the maximum lump sum and pay the unauthorised tax charge, because your residual pension will be less, but your commutation will be higher. But also you can take an amount between 0 and the maximum lump sum. So say you wanted to pay off your mortgage and it was £100,000, and your maximum commutation was 150,000. You can just say, I want to take 100,000, but you won't have that. You won't be able to give that choice on the forms they give you. You'd have to go back to the administrator and say, I don't want the options you've given me, I want this option, and they'll do that. So if the 2015 has been taken at the same time as 1987, if you're 55 and or over, then again, you can still take no commutation and take both gross pensions. You can take the maximum tax-free from both or just from the 1987. You could just take the maximum from the 15. I say, not financial advice, but that would be a strange decision to make. You can take the maximum from both and pay the unauthorised tax charge on the 1987, or just take the maximum from the 1987. Or again, you can take an amount from 0 up to the maximum from both. So you can say you don't want to take all of the 15, you can take all of the 87 and some of the 15. So that there's quite a lot of flexibility here with the choices that you have. The 2000, if you're a 2006 member, if you're a 2006 member, you'll be able to take the 2015 commutation at the same time, because you will be 55. Take the automatic commutation, which is 4 times the gross pension. Don't take any, and take the gross pension with the commutation converted into pension. And I say that there are tables within the links to show how much you get back, how much extra pension you get. And members have the same choice for the 2015 interaction with the 2006 as with the 1987. Just the maximum in the 2006 and 2015 is always tax-free. And if you're a pure 2015 member, the 2015 is the only pension you've got, then you can take the maximum at the 35.7%. You can take the gross pension and not take none, or you can take the amount between. So there's only 3 options: take an amount between 0 and the maximum, because the 2015 commutation will always be tax-free. So as you can see from that slide, there are a lot of options and lots of flexibility in what you can take from the pension schemes. And don't be people say to you, oh yeah, you should do this, you should don't do what they say you should do what is best for you, and make an informed decision for your own circumstances. Thanks, Claire. Pensions, yeah, so index linking. Pensions are index linked from the day after leaving, including deferred pensions. So the day after you leave, they will start to be increased with inflation, but you don't get the increase. Ordinary not paid until 55. There are some, obviously, if you're ill health retirement and things like that, there are some exceptions, but ordinary not paid until 55. So if you're a 2006 or 2015 member, you're going to be 55 when you start taking the pension, and the index linking will kick in from the, because you won't have left until you're after 55. The index linking will kick in from your 55, and you will start getting increases each April. For those that left before 55, you'll get a one-off cumulative increase at your 55th birthday. The government publish pension increase tables each year, and that's the link for them there. They publish them every February, and so they deal with then up to the April. So all we've got at the moment is commutation and factor tables that go up to April 2025. Nobody can work out subsequently from April 25. Nobody can work out what that's going to be until next year when they publish the next tables in February 2026. So we get one-off cumulative increase at 55. It'll be based on the April before your 55th birthday, and then subsequently you'll get the full pension increase each year. And I'm a pensioner, and I got 1.7% in April, and I'll get whatever the CPI is in September next April. But I got a one-off cumulative increase when I was 55, because I left when I was 51. But it's a one-off, no backdating. It increases your pension, which stays the same going forward, and then is increased each year by the annual increase. IHR pensions are index linked, and that index link is paid immediately. And with the first payment will be the following April. Injury on duty pensions are index linked, and that index link is paid immediately, as with IHR pensions. And we don't really need to worry about, but deferred 1987 pensions are brought into early payment due to ill health, are only index linked immediately if the officer is permanently disabled for regular employment. Deferred 2006 and 2015 pensions brought into early payment due to ill health are only index linked if the officer is totally and permanently disabled, 98 to 100% disabled. So there's different index linking provisions for the different, but for active service 55, and if you're a 2006 2015 member, you'll get the next April increase. If you're somebody who left before that, you'll get the cumulative increase at 55, and then following on from that, you'll get the increase each April. Deferred pensions, if you got deferred pension and then you carry on with that deferment until it goes into payment, then it's index linked from the date of payment, but the index linking will go back to the date that you left, the day after you left the scheme. And I think up until April 2022 to April 2025, the index linking increase was 19.47%. Which was big, because I've just done one for somebody this morning who left in 2020. So from 15 to 20, from 1st of April 15 to February 2020, it was only 6.5%. From April 2022 to April 2025, it's 19.47%. So the past figures can't really reflect. We don't know what the future inflation is, so you can't really. You can have a guesstimate, because the Bank of England should be trying to keep inflation at 2%. So you can have a good guess at it, but we don't know, because inflation goes up and down, and we've had years where it was negative. If it's negative, they don't take your pension down. Thanks, Claire. As I say, not a great subject, but something we all need to know about and need to be aware of. All active members are in the 2015 pension. If you leave the pension, you lose the death in service benefits. It can be covered quite cheaply with term insurance, but it's something you need to consider if you are considering opting out. You do lose a death in service benefit. It's 3 times average pensionable pay. So for a PC now, £150,000. There's a hierarchy of payment. So if you've got a spouse or civil partner, it would go to the spouse or civil partner. We've had a piece of good news, which is unusual for pensions at the moment, but we had a piece of good news. There was an inheritance tax consultation, and they were talking about putting the death in service into the inheritance tax picture for an officer. They've decided not to. We did respond to the consultation. They're not doing that now, which is relatively good news. They did listen. So it would go to spouse or civil partner in the first instance. If you haven't got a spouse or civil partner, a declared partner, we'll talk about declared partners in a minute, at the discretion of the Police Pension Authority. The Police Pension Authority is usually your Deputy Chief Constable. It should be effectively your Chief Constable, but they delegate it to either the Deputy or to a Deputy or a senior civilian. There are nomination forms for the 2006 and 2015 schemes for declared partners. We would recommend you do fill those forms in. If you are cohabiting and you're in the 2006 and 2015 pension, then fill out the declaration forms. That would be our advice. They're not a requirement, but they're a recommendation, because if you don't fill them out and something does happen, then the cohabiting partner needs to go to the Police Pension Authority at an awful time in their life and prove that they were cohabiting with somebody who just died. If you fill out the nomination forms, that's an admin piece, a piece of admin that doesn't need to be done. So the declared partners are next in the hierarchy. And also, if you haven't got a spouse or civil partner or declared partner, then you can nominate somebody. So again, there are nomination forms for the death in service benefit, which are available from your administrator. So you can get them from your administrator. Again, worth filling out. Also, the bottom bit, group insurance. If you're in the group insurance, and a lot of people will fill out their group insurance form when they first join the job, so they leave it to their dog or to their mum or whoever they leave it to, or to a partner. Make sure that the person that on your group insurance is the person who wants to leave it to now, and keep that updated. We can change it. The Federation can change it. The trustees can change it, but it takes quite a bit of doing, and it's about £4,000 to do so. So make sure your group insurance beneficiary is the person that you want it to be, and you can do that by contacting your local Federation office and ask you who your beneficiary is. Going back to death in service, so if you haven't got any of those first three, then it'll go to the executor of your will. So it form a benefit, a part of the estate, and as I say, it won't be a part of the inheritance tax now, which is good news. And we encourage the completion of those nomination forms because it's useful housekeeping. Sorry, I just pressed the button. I don't know why I did that. Claire, please, next one. So yeah, in a similar vein, all of the, sorry, gone one too far. Can we go back one, please?
Yeah, sorry, it didn't work the first time, Paul. So we go back to survivor benefits.
Lovely, thank you.
There, yeah.
So in a similar vein, all of the pensions have got survivor benefits. 1988, they're different, as you can as you probably get the gist of now, that they're different. So the 1987, you must be married or in a civil partnership, same or mixed sex for both. It's not for life either. So if your survivor, so if unfortunately somebody does die, the survivor pension is not for life. The survivor, if they, and they, this is, survivor is a strange expression, but this is what this is the terminology they use in the pension world. It's not for life if the survivor cohabits or remarries. We took that to the High Court with NARPO. NARPO took it onto the Court of Appeal, and we lost both. I see that NARPO are trying again to change it, but the courts seem to be very, very reluctant to change the 1987 pension. It can be reinstated if the circumstances change. So if the survivor then gets divorced again, or the person they remarried dies, then they can go back and get the survivor pension again. Question I get all the time: do I need to be married before I retire? No. Post-retirement now, marriages now count. They didn't at one point, but it's only for post-April 1978 service, which won't affect anybody on the call today, but obviously it affects retired members. It does female officers also who had service before 16th of May 1990. They would have had to uprate their pension for those pension contributions for widower benefits. Again, that's becoming less and less of a problem because we're getting further and further away from 1990. So the survivor benefit for a spouse civil partner in the 1987 scheme is 50% of the pension calculated upon death, or 50%. So if you die in service, it's they calculate a enhanced ill health retirement pension and pay 50% of that. In the 1987 pension, there's also a 13-week uplift if you're in service. For the first 13 weeks, they would pay your beneficiaries your salary. After the 13 weeks, they'd pay the pension. And if people are retired, you get 50% of the pre-commuted pension for retired officers. So say for me, it'd be just more than half of what I receive each month in my pension. If you've got children who are 23 years or younger in full-time education, they get a pension too. Also, if a children is disabled and dependent on you financially, that can go on for the rest of their life. In the 1987 scheme, and in both schemes, you can only get a maximum of 2 children. So it's 18.75% of the pension for each child, up to a maximum of 37.5%. And that's shared between however many qualifying children. And we do get that shared across relationships if an officer has had children with more than one partner. So that can go across relationships. And so say you've got 3 children, they'll share 37.5%. When one of them drops out of the equation because they're older than 23, then it will get shared between the 2 children. So the 2006 and 2015, that's a little bit different. You can be married or in a civil partnership, or the partner declaration that we discussed just in the last slide. And also, it's payable for life. There is no cohabitation or remarry provision in the 2006 and 2015 scheme. So if the survivor cohabits or remarries, they keep the pension. They keep the pension. So what you could have, if you have a cohabiting partner and you're not married or in a civil partnership, you could have they could have a surviving partner pension, but not a pension from the 1987 scheme. We're not forcing people to get married, but people do get married for the pension. I know some people get married for love as well, but we have had people get married just because of so that the pension carries on. Not great, yeah, but yeah, I probably shouldn't get into that. So again, it's 50% of the pension for survivors. The partner declaration is no longer, up until 2017, the partner declaration was a requirement, but there was a case in Ireland where that was then negated out. So the partner declaration is no longer a requirement, but we would still advise that they are completed. And the children is the same as the 87. It's 2 children again, maximum of 2 children, but it's 25% of the pension payable with a maximum of 50%. So it's a slightly higher amount for the children. And so you'll have these slides. So if you wanted to look at that again, it's useful for if you're doing insurance planning, mortgage planning, to know what the survivor benefits are, and your mortgage company may ask you for this. Thanks, Glenn. Remedy, you'll all be aware of the remedy. The transitional protections that were, so what happened, Lord Hutton was asked to do a report by the previous government about public sector pensions, not just police pensions, about the whole public sector pension arena, and came up with a report that he named called the Hutton Report. He said that he didn't want any transitional protections, that everybody should move across to the new pensions, the new reform pensions on the 1st of April 15. No transitional protections. Transitional protections were offered by the government, were taken up by all of the public sector, and then the FBU and the judges challenged that, and they were found to be unlawful. And that's why, and remedy is the rectification of the unlawful, the unlawful discrimination that was found because of the FBU and judges case. To say it hasn't gone well is an understatement. So what should have happened now is all officers should have been rolled back into their legacy scheme for the remedy period. So from the 1st of April 15 to the 31st of March 2022 is the remedy period, and all officers should have been issued with a remedial service statement. We think there are more than 10,000 still outstanding remedial service statements. That remedial service statement would have triggered a contribution adjustment that was needed to be sorted out, and we'll talk about that in a minute. And to be in scope for remedy, a member needs to be in pensionable public service on or before the 31st of March 2012 and on or after the 1st of April 2015. We've had some forces push back because there are a lot of people that fulfill that criteria who weren't police officers on the 31st of March 2012, but were in public sector employment and in public sector pensionable employment. PCSOs, DDOs, station officers, people that were in other parts of the public service. So police, so if you're getting pushback on that, speak to your local federation, because you shouldn't be getting pushback. You should be subject and in scope for remedy. 31st of March 2025 was a deadline for the issue of the RSSs. This was not met in full. Some were so that's either a breach or an extension. The scheme manager, chief constable, can extend within the regulation. They can extend the deadline, and some now are extending until next March, which is not great. So it's either a breach or an extension. A lot of officers haven't been told which it was. It doesn't really make a lot of difference. It's still not great. Our view was to take out the internal dispute resolution process within force, make a complaint to your scheme manager, and start the internal dispute resolution process, which can then take you onto the pension ombudsman. And say the whole session can be done on remedy. We'll talk about interest in a minute, and then we'll talk about some of the other issues as we go through it. But as I say, the NPCC say there are 10,000 outstanding. I think it's probably a bit more than that, but we can't say because nobody's got all of the figures. But your chief constable, your scheme manager, should know how many RSSs within force are now still outstanding, should know for what reason, and should be getting on with it and dealing with it. At some point, they keep saying about, oh, we can't get the data. Well, at some point, if you're not going to get that data or never going to get that data, you're going to have to make some assumptions and get on with it and get people remedied and get it sorted, and so we can move on. Thanks, Claire. So, we're now back into another ABS RSS annual benefit statement, remedial service statement options rollout. So you should be getting, if you haven't got it already, you should be getting shortly a annual benefit statement, remedial service statement for 2025. And it gives you another chance, not for the 2006, but the 1997 chance. It gives you another chance to look at the contribution adjustment. The 2006 scheme, if you're with a 2006 scheme and were either tapered or unprotected, if you were fully protected, there is no contribution adjustment owed to you or owed by you because you paid the right contributions. 2006, if you're unprotected or taper protection, then they owe you money. Just by taking the refund or paying the contribution adjustment in 1997 doesn't mean you've made your choice. You don't make your choice until a month before you retire. All you're dealing with now is the contribution adjustment. So for the 2006, you can take it at any time. Don't let them tell you that you've only got 12 weeks from the date of your ABS. You can take it any time. The legislation clearly says it. The NPCC will confirm that. If you get any pushback on that, come back to us again and we will take it up with the force, because you can take it at any time. But what you got to remember is you can take it now or we can take it later. But if you take it now and then you choose the 2015 benefits at remedy, you'll owe the contributions back again, and you'll owe interest on that. So that's something to bear in mind. You could keep the money where it is, and keep it in your contribution account up until 28 days after your remedial service statement. The interest was being accrued at 8%, and then after 28 days after that, it becomes the NSI direct saver rate and will be the compound rate for that until retirement at 3.3%. That's variable, so that could change. It was 4.7% when we first started doing this. But also, you could take the money out and spend it. You could take the money out and invest it yourself. But as I say, you can take it any time. You don't need to. You're not limited with a 12-week window, which you are with the 1987. Next slide, please. So the 1987 scheme, there is a 12-week window, and that 12-week window will now be opened or opening again because the RSSs have been produced for 2025. Again, you can pay the contribution adjustment now or pay it later. Pay it every year. We'll have a 12-week window, or you pay it at retirement. The net figure should be provided now. Some people are saying their contribution adjustment's gone down in the last year. That may be because last year gave you a gross amount because they hadn't worked out the tax relief, and some have now worked out. So some contribution adjustments will have gone down this year. And if you paid one with the gross, make sure that you get the net figure and get a refund, because you should have got tax relief on the amounts. Again, if you're a fully protected member, then you don't owe anything. It's only if you're a tapered or an unprotected member. I say you can pay it in next year's 3-month window, or this year's 3-month window, or up until retirement. If you don't pay, the interest continues to accrue compound at the NSNI direct saver rate, so it gets higher, and that's 3.3%. We're not talking about huge. I hate the interest side, and we've really worked hard to try to get the interest sorted out, but we can't get anywhere with it, and I really think it's unfair. But the interest rate is now 3.3%. It's likely to go down further because the interest rates are going down. So you can work it out. If your debt's around about £2,000, which is reasonable for a PC with a full 7 years, it's going to go up by about £60 each year, but it'll go up a little bit more than £60 because obviously it's compound. I say totally unfair, totally unreasonable, unfortunately totally lawful. Next slide, please. And which brings us on to interest. And I say we've really tried hard. We've done everything we can with the NPCC, Home Office, scheme managers, and at one point nobody agreed with the interest apart from the government. But the NPCC and the scheme managers doubled down and said, well, it's public money, Treasury rules, and basically falling in beside the Home Office. It is a kick in the teeth. It's unfair, unnecessary, and we've lobbied against it and taken legal advice. And unfortunately, legal advice said it's unfair, but it's not unlawful. Their rationale is it would be unfair on protected officers who paid the contributions at the correct time. I don't think to mitigate that is the correct way to go about that, to charge officers who could not pay the contributions, didn't know they owed the contributions because they were being discriminated against. Is that the right way forward? No, I don't think so. You can get to the and chief constables and scheme managers can waive it in certain circumstances. We can have situations where children of officers who died in service will be charged interest on the contribution adjustment change that they make. Is that what we've come to? And as I say, I will still keep moaning about it and keep harping on about it every avenue I can, but we're not going to get anywhere with it, unfortunately. Some of the Met at the moment are waiving interest if you make the contribution. If you pay the contribution adjustment for the 1987 in full, and you can pay it with the Met, you can pay it via payroll over the next 3 months. They are waiving the interest, so that they won't calculate interest beyond the 31st of July 2025. If you're waiting for an RSS, why should you pay any interest beyond the 1st of April 2025? So if you're one of those people, I would go back to them and say, can you please calculate how much interest I've accrued since the 1st of April 2025, and then put a compensation claim in for that. When they turn that down, or if they turn that down, then say, all right, I want the IGRP. Go to the pension ombudsman, get a ruling from the pension ombudsman. We may not get a favourable one, but let's go for it. Same with when you retire, pensions are paid in advance. A lot of county forces don't do it. Don't pay it in advance. They'd say, oh, we'll pay you 2 months in 6 weeks' time. Or we'll pay your commutation in a couple of weeks. Not good enough. They charged you interest on every penny of your contribution adjustments. Go back to them and say, I want interest on the commutation that you didn't pay me for the last 3 weeks and the pension you haven't paid me for the last 6 weeks. I know it's picky and probably a little bit I don't know, snidey, but that I feel really strongly about this. If they can manage to charge you interest on everything that you owed, you can make sure that they pay you interest on things that they owe, which they should have paid to you. So I need to take my blood pressure tablets now. So can we move on to the next slide, please, before I start swearing? Contingent decisions. So we've got some of these now will be you'll be out of time. But even if you're out of time, I wouldn't, and you fancy one of the contingent decisions and you fit the criteria for one of the contingent, I would still ask your force, because they've made such a mess of remedy. I would go down that route and say, well, because remedy's gone so badly, I am maybe a little bit out of time, but look how much time you're out with lots of these things. So I wouldn't put it to bed completely. And also, if you're just getting your RSS for the first time, the dates on here, the time limits are from the date you receive your RSS. So opt-outs, if you opted out if you opted out because of the remedy, either before the 31st of March 15 or after the 1st of April 15, you can apply with a contingent decision to buy that service back. And then we've got a lot of officers who are waiting for that. Unfortunately, that's currently paused because what's happened is the government, the legislation has been written wrongly. They accept it's been written wrongly, but they are not in the mood to change it. So what at the moment they're doing, they're scoping a compensation framework so that officers can buy their service back, and then will get a top up in compensation for what they would have got in 1987. It is really, really complex. I've had 3 meetings there with the Home Office, and it is mind-blowingly complex. So that's a work in progress. So if you are one of those people that opted out because of the remedy, I would still put a contingent decision form in now, an application to buy back that opted out service. I think we will come to a resolution. What that resolution will be, it may be this compensation framework, it may be that they go back to the Treasury and say, change the legislation, please. That is our policy position and we've gone on about this for over the last year. Our policy position is change the legislation to make it fit the policy intent, but they're very reluctant to do that at the moment. So that's contingent decision for opt-outs, people who opted out during the remedy period. Honorary is a bit of a niche one. It's for superintendent, chief inspectors who acted up or temporarily promoted to superintendent. They could get honoraria rather than their pensionable payment. Well, they can swap that decision, but that's a bit of a niche. Again, if you are a superintendent or a chief inspector in that position, then still put it in now. You may get knocked back, but say give us some leeway because the remedy's been so badly handled. Same with additional service. You've got 12 months from your RSS to make an application to purchase additional service in the legacy schemes. Lots of people ask about this, but lots of people then don't bother because when they see how much it is, it's too expensive. Because you've got to make up not only your own contributions but the contributions of the job as well, and it's 35% is their contribution, so it's a big old chunk. Same with transfers. We've got 6 months with transfers, and same with additional service. Before making a long-term commitment for additional service or for a transfer and a pension in, it's prudent to get some financial advice. You've got 6 months to put. If you've got a pension out there from another occupational pension scheme, you can apply through a contingent decision to bring it into the legacy scheme, not the 15 scheme, into the legacy scheme. But you've only got 6 months from your RSS to do that, so it's worth having a look at that if it does apply to you. You may get knocked. We've had lots of people knocked back on that with the saying that it should go in the 15. No, it goes into the legacy, or can go into the legacy scheme. We've also had a few people that have been told that they transferred pensions in during the remedy period when they were in the 2015, that it will stay in the 2015. It shouldn't stay in the 2015. They should give you an option for the 1987 or 2006 and the 15. And also we've had people who put added pension in during the 15 during the remedy period. Forces had to refund that with interest, and some people haven't had that yet, but they should have done. Sorry, Claire, please move on.
Oh, just a very quick question. Seeing that there's no such thing as a full pension now, as what you said at the beginning, can you still buy additional years for the 2015 though?
You can, and we will cover that a bit later. You can buy added pension, yeah.
Lovely, thank you.
No worries. Annual allowance, pension saving statements. Again, these should be issued again very soon if they're not been already. Pension saving statements will be issued for people for the 2020. So if you've increased your pension pot by more than 60,000 or could have done by more than 60,000 in the last year, you'll get a pension saving statement. This again is more for the higher ranks, but a sergeant being promoted to inspector can get them. Inspectors can get them, and superintendents, superintendent definitely get them, and superintendents get them most years. For the remedy period, it was 40,000. The annual allowance is now 60,000. If you do get one, if you are an officer who gets a pension saving statement, go to that link, the HMRC link there, and fill in all the figures from your pension saving statement. And what you'll probably find is most people find that although they've got a pension saving statement which says they may have reached the annual allowance, doesn't say they may have reached the annual allowance. When they put the figures into the calculator, they'll find that they've got unused allowance from previous years, which will cover it. If you haven't, then you can take tax advice if it's remedy related via the compensation framework. With the compensation framework, we advise people not to go and spend money before you get the authorization from the force, but you can get tax advice from the if it's to do with remedy and get that paid back by the force. And then if you have got a tax charge you have got a tax charge, then you can either pay it up front or you can take it off your pension via scheme pays. So and then you have a reduction of your pension going forward. But yeah, it's worth taking some advice. But in the first instance, you probably find that most people are sorted out once they go to that tax service HMRC calculator, because you'll find that they've got unused breaches, so unused allowance from other years, which means there's no tax liable. Next one, please. So that the compensation, I say you can apply for compensation for tax advice if it's to do with a remedy. Your force should have a compensation policy for the remedy compensation. Some of them have, some of them haven't, some of them aren't so good as others. We've had some of the big forces have had some ridiculously low numbers of compensation claims, but make a compensation claim. If you've got a direct financial loss because of discrimination or any of the provisions of the two acts. If you've got a Part 4 tax loss, so if you incurred a charge or not been entitled to tax relief under Part 4 of the Finance Act due to be out of time because of a tax loss, then you can claim that back. Costs of independent financial advice due to remedy or tax advice due to remedy can be claimed back. Divorce is going to be a big one. I think we've got a slide on divorce. Sorry, I do so many presentations now, but I think we've got a slide on divorce. We've just had the guidance for retrospective and prospective divorces. So retrospective divorces up until the 1st of October 2023, prospective beyond 1st of October 2023. If you think it is the retrospective guidance is 90 pages long, and one of the cohorts is that there is a page and a half of acronyms. It really is it's ridiculously complex. But what we think will have to happen is that anybody who's got a pension sharing order during the remedy is going to be recalculated, and that may then not fit with what the divorce court wanted for the sharing. So we think people will have to go back and revisit that, and then they're going to need to employ a solicitor to do that. Well, if you have to employ a solicitor to do that, then divorce is one of the reasons you can claim compensation, and we'll have to do so. We've got some legal advice. I'm just going to put some legal advice in this week because we only just got the guidance for that. But as I say, that you can claim it if the extra costs of the divorce are because of remedy. But as I say, we would advise that officers get the authority before laying out money on advisors. Some forces say, oh, there's a cap of £1,000. There is no cap on how much can be claimed, and there is no time limit. This will go on for years, because as people get towards retirement, then they can, and there's no limit on how many times you claim. You can have more than one claim, but some forces are trying it on. So, and you can appeal, and if the appeal is unsuccessful, then you can come to the Federation and we can take it up with the forces via the NPCC. That's compensation. Next one, please. There you go, Mel. Added pension. There is an opportunity to make an additional contribution to the 2015 pension scheme, and it'll buy you an additional amount of pension. So it's not like in the old days when you bought additional service that bought you additional time in the legacy schemes, this buys you an added monetary value. For 2024-25, it was £8,715 was the limit of what you could put in. Check with your pension administrator for the current arrangements, and get the details from your pension administrator for the current arrangements. There's no employer contribution, and it buys an extra annual amount in pension. And the administrator should provide an example of what the contribution would buy, because the variables are difficult to quantify, but they should give you an example of what it buys. You can buy either added pension without survivor benefits, or you can buy added pension with survivor benefits. The added pension with survivor benefits is obviously more expensive. There are tax relief on contributions, so we get a lot of inquiries about this now because people are above the 40% tax, want to take themselves back below the 40% tax, so you get tax relief on the contributions. A SIP, a self-invested pension plan, can, this again not financial advice, but a SIP can achieve the same effect. Because one of the problems with the added pension is, if you then leave before 55 or you leave at 55, the actual reductions will be also have an effect on your added pension. So if you put money in, it could be reduced by 22.5% or whatever the actual reduction is before 60, or it could be reduced by 50%. So again, if you're before you take a long-term commitment on added pension, I would get some financial advice would be prudent, because I'd say that actual reduction thing is quite a negative of an added pension. If you're going to go on till 60, yeah, that's a bit different, because there will be no actual reduction there. And if you went on beyond 60, the actual increases would be available. So it depends on your circumstances, but that's one of the big issues that you need to address. Next, please. So we are coming to the end now, and the last sort of bit we're going to talk about is pension forecasts. Everybody wants to know how much pension you're going to get, when they're going to get it. The problem you're going to have is, if it's beyond 12 months and you don't know the pay rise and the inflation, anything beyond that is going to be variable. And as we saw earlier, we had inflation of 10.1% not long ago. It's more likely to be 4% now, but it could be 2%. And so there are variables. You don't know how much the pay rise is. You don't know whether it's going to be a pay rise. So forecast. So like XPS will only give one for 6 months. I'm lobbying them to try and do 12 months, because I think 12 months is much more practical. Equinity will forecast for any date in the Met, but they only use current pay scales. So when you get your 1987 for next year and you want it 5 years time, it doesn't reflect reality, because you're looking at the pension with the same average pensionable pay. So it's difficult. So, and the further away you are from retirement, the more variable and the less certain you can be of what that forecast is. So yeah, that's a caveat with forecast. But it is your employer's responsibility and their administrators to provide those forecasts. They will provide you with the annual benefit statement. The annual benefit statement only shows until 60, so for most people that's not of much use. The Met this year have done 55, which is helpful, but I don't think any other force has done that. So that is helpful. And again, we've lobbied the NPCC for 55 to be put in, but their view is, oh, the Met shouldn't have done it, rather than the others should do it. But 55 would be more useful. There are 12 police pension administrators. XPS are the biggest, Equinity are the next, and then some other forces. The Welsh forces are done by local councils, and there are some other administrators. The dashboards they should have done it by October, but I don't think it'll be till next April. In April next year, there will be pension dashboard, so you'll be able to go onto a pension dashboard via Money Helper or one of the websites that will be available, and it'll give you all your pensions that are not in payment in one place, so any private pensions and your police pension. But it's not going to be particularly helpful, because it'll only be the annual benefit statement that'll be on there, so you will already have that. I know XPS are working on more AI examples and AI provisions. But again, you still got the same caveat. There are some, the further away you are, the more unknowns there are, the less reliable your forecast will be. Part-time officers can get the record or calendar service from their administrators and should do so. It's important, the annual benefit statement might be of not much use to you, but make sure the details on it, use it as a good housekeeping tool to make sure your service is right, make sure your date of birth is right, make sure any service you brought in is right, make sure you're part-time right, make sure that I had one yesterday and she still thought she had 30 years, and when I looked at it I said, you got 127 days short of 30 years, and I said, you take some unpaid leave. So she's now gone back to the administrators to find out why there's a gap of 127 days in her reckonable service. The link there at the bottom is the police pension administrator contacts for each of the forces, but hopefully within force you'll be able to get that easier anyway. But it's there. Next, please. So the NPCC have got a pension calculator, which the links there below, and I definitely would encourage people to have a go at it. You want to know which legacy scheme you're on. Then there's some eligibility questions about date of birth, date of joining. If you brought pension in, then use a notional start date. So bring your start date forward, and it'll want your current salary and the salary at the 1st of April 15. I've got a slide in a minute with all the salaries at the 1st of April 15. There's a bit for part-time hours and about promotion as well. So you can put your part-time hours in as well, and about promotion. Promotion is going to be a bit more difficult if you're promoted within the remedy period, but again, we'll deal with that on another slide. The calculator makes some assumptions, so it's trying to give you some realistic view of what the future looks like. So it looks at 2% inflation, so the 2015 pension increases by 3.25% per annum, and 3.25% per annum pay increases. That may or may not be correct, but it falls in with the recent pay. The pay rises recently have been more than that. And that's one of the things with the commutation. I know there's a lot of negativity in pensions, and probably quite a lot of negativity in this presentation, but the commutation factors have gone up a lot since I started doing this job in 2016. They've gone up by well over 10%, the commutation factors. So that is a positive. And also on the NPCC calculator, there is a your choice section which allows you to change the assumption. So you can put more pay rise, a bigger pay rise or a smaller pay rise. So it's quite flexible, and you can play around with it. Next slide, please. So I'll use a live example for a non-MET PC who was born on the 12th of July 1975 and joined the job on the 1st of September 1999, so was a 1987 legacy member. No part-time, no unpaid leave, and no pension brought in. Current average pension pay at the 31st of August 2025 is 48,231. The pension pay, that's the one in brackets, 51,255, is a MET PC with the London weighting attached. Their pay at the 1st of April 2015 was 36,885. Again, that one in brackets is 39,186. It would have been a MET PC, and there's no CRTP in that 36,885 because at the 1st of April 15, the CRTP competency related threshold payment, that seems a long forgotten benefit. That was £600. They were phasing it out in 15, so it was £600. So if you were getting that and you want to put your salary in for the 1st of April 15, you want the salary at the 1st of April 15 plus the £600. So that's the figures for the live example, the parameters that we've used. Next one, please. So you'll need to work out your average pay. So this one was quite easy. For the 31st of August 2025, it's easy because it's just 5120. It was the 48,231 because that was the pay rate for the whole year. So you've done a whole pay year. That includes that's the pay rise pay from the 1st of September 2024 to the 31st of August 2025. But if you want to do any other date, say you want to do the 31st of December for a non-pets, because it changes daily. So if you want to do it for any date, this is how to work it out. Don't get too hung up about this, but you can do it. You'd have the slide afterwards to play around with. So the basic pay for a PC at the 31st of August 2025 was 48,231. The figures in brackets are all the MET figures. The basic pay at the 31st of August 2026 for a non-Met PC will be 50,256. That's the average pensionable pay. That's the pay that a PC is receiving now, but the average pensionable pay figure won't be 52,256 until the 31st of August 2026. So you take the one from the other. So the annual increase this year for the non-Met PC is 2,025. Work out how many days there were from the 1st of September 2025 to the date you want. So the 31st of 12, 2025 is 122 days. You multiply the annual increase by 122 divided by 365, which gives you an increase of £677. You add that to the basic pay from the 31st of August 2025. So the basic pay at the 31st of 12, 2025 would be 48,908, which is the 48,231 plus the 677. And you can do that for any date. So that's how you work out your average pensionable pay for the coming year, if you want to put it into the calculator. Next one, please. These are the average pensionable pay figures at the April 2015. So you'll need this for the calculator. They're all for, so it shows the ones on the left, they're all for non-Met PCs. CRTP was £600. Met PCs, so not Met PCs, Met officers need to add 2,301 to each one. London inspectors and chief inspectors get a different pay rate. So, but that's all the pay rates you will need to put in for the average pensionable pay at the April 15. Next, please. Again, you can see how much the pay's gone up since there was a fallow period, but in the last 3 or 4 years, the pay's gone up considerably. So what was it? That was 36,885, and it's 50. What did I say for the PC? 50 something, 52,000, wasn't it? So that, and this is what you'll get from the. So once you put all those figures in, this is what you'll get from the calculator. It shows you your exit points. So this person, the live example, can leave at 50 with the commutation capped, can leave at 54 because that's their 30-year service. They can leave at 55, so it shows 55 because that's the first time they can take an immediate benefit from the 2015 scheme, and can leave at 60 because that's the normal pension age. So it will show you, for your own example, it will show you what's available to you. There are some issues with it. I can't fit it on the slide, but just above these figures, there's a slider. There's a slider for the 1987 commutation. There's a slider for the 2015 commutation. You need to take, when you first read this, you need to take the 2015 commutation down to 0, because the first two, the commutation will show the 2015 scheme commutation. Well, you can't take the 2015 scheme in the first 2 examples because you're only 50 and you're only 54. So take the slide down to 0, and that will show you the exact exact position for those two dates. You can use the slider also for the 1987 if you just want to see the gross pensions, and just have a play around with it. If you are over 55, then your exit points will only be 55 and 60. So the exit points will be different, but that's what it shows you, the access points, the exit points for your pension. But as I say, that's a bit of a bugbear. I don't know why they've done that. It's a bit of a bug, really. The 15 commutation shouldn't be in those first 2 examples. So take the slider down to 0, and then that will show the true picture. Next slide, please. And I've already said that. Oh yeah, and also the no tax on the legacy scheme commutation is shown. So it'll show the maximum commutation available, which is the maximum lump sum, but it won't show the unauthorized tax charge. And as I said earlier, at 55, this is just a guide, but at 55 it's 8% of the commutation you lose for the tax charge. At 50, sorry, at 50 it's 8%. At 55 it's 5%, and at 60 it's 2%. So that's roughly what you'll lose out of that commutation. That's what you've got to factor in when you get those commutation figures from the NPCC calculator. And if you click on any column, one of those exit points, you click on any of those columns, it tells you the parameters they've used. So it gives you that, and that's just an example of the parameters they use for the 25 years of pensionable service. So each exit point will show you the parameters they've used. I say it is a useful tool, and it's worth playing around with. But I say the longer you are away from retirement, the more caution you need to treat the figures with. Next, please. Yeah, so yeah. So if you're in the 2015 scheme, it won't work for you because it's a remedy calculator, and there is no, I don't know of, and if anybody does know of, then please let us know. But I don't know of any 2015 calculator out there. And this is 2015 scheme officers and promoted officers. If you want to work out the 2015 scheme, you can get a figure for your legacy and reform position on your 31st of March 2025 annual benefit. So the annual benefit statement you're getting now will measure up to the 31st of March 2025. You all should have one of those. So you can get the legacy and reform position from there. All you'll need is a reform position, the 2015 position. So it'll be on your annual benefit statement. So you'll know what your 2015 scheme was at the 31st of March 2025. You can then work out what it will be this year and every year going forward. So you can work out what the 2015 scheme will be. We can't accurately work it out because we don't know we know what the pay rise is, but we don't know what so we know what the average pensionable pay will be for this year. So that can go in what can go into the pot, but we don't know what the CPI is until October. So in October, you better work out what the 2015 pension is next year, the 31st of March 2026, and then you can do some assumptions and do it year on year, and so you can carry on doing it for as long as you need to. So you take the average pension pay for this year and divide it by 55.3. That gives you what goes into the pot for a year. And then can we calculate using the information on the previous slide? So you can go forward as many as you want. You know, it may be a bit laborious, but you know, it's something you sit down with an Excel spreadsheet or a pen and bit of paper, and you can work it out. So if you use 2% inflation each year, then you could say you could put a couple of percent on for pay rises each year, work out the APP. So basically get the APP for this year, which you can work out, and then put 2% on it for the next year, and then just do the uplift example for each year and if you want to use 2% inflation, which is the Bank of England's target, then you'd have a good guide for the 2015 pension for as long as you want. I'd say that the average pension pay for this example was 49. Was it for this one? I don't know, but so 49,407 is going to be somebody's average pension pay within this next few months, and so £893 accrued this year. No, sorry, I'm talking rubbish. That is the average pension pay for April to April. So that is the accrual this year. £893 for a non-Met PC will go into their pot for the next year, and then it will be uplifted by inflation plus 1.25% next year. We've added to that figure there, the 31st of March 2025 figure. So have a read of the slide, have a look at it. You can work out the 2015 scheme. If you're not promoted or you're not 2015, just use the calculator, and the calculator will do it for you. But if you're a 2015 scheme member or you were promoted in the remedy period, then you can work it out yourself. And if you want to, you can check the calculators right by doing it by working it yourself. So yeah, repeat it for each year, do it as long as you want. Next slide, please. And you were glad to hear this is the last slide. So I've put some useful information on here. As Mel said at the start, you're going to get the slides. There's some you'll have all the links within the slides. The first one's our pension update website. It does need some work on it, admittedly, because what's happened is we've been putting all the updates on there, and then the updates have started to consume some of the information. So we need to tidy that up, and we will do that in September. I know it is September now, but we'll do it this month. So that and one of the things is the useful information tab. The useful information tab has got some more stuff, all the regulations, all the members guides are on within there. The members guides are a good place to go to read about the pensions. The NPCC pension website is a really excellent resource. Lots of information about there, especially about remedy. And one more point I'll make before I stop. That last one is a useful one for everyone, really. Up until April 2016, police were contracted out SERPs. So though you were paying a lot in national insurance, you weren't getting a full year's national insurance record for doing a year in the police. I left in 2016, and I've only just got a full state pension provision because I had to work another 9. I've been working since I was 16, and it feels like it today. I had to work another 9 years to get a full pension record. So go on to check your state pension. You have to put some details in, national insurance stuff. and it'll come up with how much the maximum state pension is at the moment and what you would be entitled to and how many years you've got to do to. So if you're a long way from retirement, then it may be you've got to, you know, that's fine. But if you're close to retirement, it may be that you might have to work a bit longer or pay some extra national insurance to get a full state pension. As I say, it took me 9 years, and I've been working for, I don't know, 45 years now. You know, so it took me. I had to work 45 years to get a full 35-year national insurance record because of the contract now at SERPs. And as I say, have a look around the resources. I know I've gone through a lot. Use the slides, and if you've got queries, have a look at the websites first, and then if you've got anything that's really outstanding, go to your local branch board, and if they can't help, then come to the pension inquiries email, which was on the original invitation for this. But that's me finished.
Oh, thanks so much, Paul. You really are amazing to be able to speak for an hour and a half on this topic. So thank you so much for your time today. I know everybody appreciates the amount of information that you've given. It really is superb. So yeah, thanks again to Paul, and thanks again to Police Friendly for being able to sponsor these webinars. All of the slides will be on our website under the pensions page that Paul's shared today, as well as those that have registered for the webinar. You will get an email with the slides contained. In the chat in a second, there'll be a link to the feedback. We haven't got a QR code today, so if you could just take a couple of seconds at the end now, just give us a little bit of feedback with regards to today. There will also be an opportunity within the email that will come out to you likely tomorrow with the slides and other information for you, and for the feedback there as well necessary. So as Paul has said, our website has got loads of information on it. It is going to be tidied up and kept up to, it's up to date, but it just needs a bit of a tidy with regards to the information. There's loads of links, really useful links contained within Paul's slides as well as on the website. So do use them, especially the calculators we've said. Today has been recorded, so you'll have access to this if you want to rewatch anything or parts of it on our Police Federation YouTube channel. And the links will all be on the website there. So first and foremost, if you've got any questions, and I know we've not been able to take questions today, as I said at the beginning, there's just far too many people to do that. Go to your local branch, or go to the website so you can find the answer there. Have a chat with your local branch if you can get the answer there. And then if not, email into the pension inquiries email inbox. But I hope you found today really useful. Thanks again to Paul, who is the absolute knowledge hub for pensions. And there will be another webinar solely on the 2015 pension scheme in a couple of months' time. And if there's any reps on the call today, we are going to do another rep specific webinar for yourselves to get your knowledge up to date too. So thanks again, everybody. I think I've covered everything. Thanks, Paul. We'll catch up soon.